let's just talk. What's a 203K? How did that change your life? What is this whole thing about? Welcome, income hackers. This is your host, Ryan G. Wright. This podcast is for individuals and families who are interested in fast-tracking their financial success. You'll hear experts discussing topics like generating a residual cash flow, building wealth through real estate, financial literacy, creating a family legacy, and overcoming your fears. If you get value out of this podcast, please subscribe, rate, and review the podcast. It's a big help to me.
I kind of just grabbed her one day. I'm like, hey, listen, I'm 26 years old, whatever it was, 25 at the time. I got a couple thousand in the bank. If you could do this all over again, what the heck would you do? Like, you tell me things all the time, like, what's the best way to do it? And she said, there's this loan out there called the 203K loan. Don't know much about it, but I know that you can basically buy a foreclosed property, a distressed property, with only 3.5% down because it's an FHA loan. And I would pretty much do that, live in it, either live in the basement and rent out the upstairs and basically house hack it until you're ready to move out. And then when you're ready to move out, you move in somewhere else and you rent out that whole place. And now you have a cash flowing asset with equity in it. Now, that was just a lot. And for someone that was 25 years old, didn't really understand anything about, like, I didn't even know what equity meant, and I'm like kind of just hit with a fire hose. I'm like, I don't know what this thing is. I don't know what I should do next. And I've never heard anything about it, but let me go dig into it. So I did, and it was the best thing I ever did. And her name is Melissa. She heads the Long Island RIA group, and I owe a lot of my success to her. But basically what this loan is, it's an FHA backed loan. So just like, anyone that goes out and buys a mortgage, buys a property, gets a mortgage and pays less than 20% down, typically that's considered an FHA loan because you're backed by the FHA's basically insurance program for the fact that you're basically putting on less than 10% on a property. You're considered high risk, what have you. They also do it for renovation loans, which is basically you're able to wrap the rehab costs into your purchase price. And what that allows you to do is that allows you to compete with some cash investors, and you're able to bid on foreclosure properties. You're able to bid on properties that conventional bank financing would never approve you on. And, essentially what I did was I really, I went after it, pig-headed determination. I really busted myself quite a bit on the way, learned a lot of things. But I just knew it was the right direction, and I kept my head down, looked at the light at the end of the tunnel, and basically came up with something where at the end of it, I'm like, I got to tell more people about this, because if you leverage this loan right, man, oh man, I mean, like you said, I got a 900% ROI in the first year, and it's basically changed my life and completely jump-started my real estate investing career that I was longing for so long.
Let's talk about this whole 203K strategy. So for those that are listening, so this is actually going to a bank and getting a loan. So you've got to have decent credit. Let's talk about some of the qualifications maybe, because some people this may not work for, and others this is right up your strategy. So what are some of the qualifications to even get a 203K loan, Matt?
Sure. Yeah. So first and foremost, like you said, it's not for everyone. This is you're going to a bank and you're going for a loan that's an FHA backed loan, which means, you got the federal government behind you. It means there's a lot of paperwork. You got to fit the bill, right? You got to be, usually don't have to be, but 2 years of stable employment. W-2 earning is pretty important there. It doesn't have to be. There's a lot of ways to, talk to your lender and figure out other ways to get around that. But 2 years stable employment, and it's just like regular FHA rules. You need about a 600 credit score minimum. All right. You're going to have to be able to foot the down payment. FHA minimum is 3.5% down of the loan amount. Besides that, it's, debt to income ratio is a big thing too. I think it's around 50%, right? So you have to, your bills have to be, half of your income. They're actually pretty lackadaisical requirements that you need for it. Really what it comes down to is just getting all the paperwork up front. When I first got into this, I was able to qualify for actually a pretty small amount. But one of the beautiful things about this loan is you're able to buy up to 2 to 4 units. And this is where it gets really cool. And this is where you can get creative with it, right? And I try to tell people, don't get discouraged if maybe your income's not that great. Because in my case, I was basically able to chunk out an extra, I don't know what it was, somewhere between $50,000 to $100,000 of buying power, because I was buying a duplex. And in a duplex, I was living in one unit, and the other unit was getting market rent of about $2,400 a month. So what the bank underwriter is able to do when you find that property is they're able to take 80% of that and put it into your underwriting. All right. So that's going to qualify you for even more, which is cool. So, again, one of those little things that I did to really try to leverage this loan as best as I could, and really kind of squeeze it for what I could and get qualified for that loan.
Yeah, that's great. So just to clarify on a few things, so does it have to be owner occupied on the 203K?
Yes. So
you've got to live in the property.
Yep. So it's an FHA, owner occupied loan. They're giving you that good low down payment. They're giving you a pretty favorable interest rate. Your typical homeowner interest rate. I think I paid back in 2016. I was like, my interest rate about 4.5%. Maybe a little less, maybe a little more now, depending on when you listen to this. But it's favorable for that. Now, I try to tell people, it's your first house or it's your next house, and it doesn't have to be forever. You should go into it with an open mind. In my case, it was my first real property that I was going to own under my name. So it worked for me. There's a lot of people though that I've talked to that I actually mentored and are interested in what I do, and they're moving into their next property using this strategy. So as long as you live there, and the FHA standard is you got to be there for a year. Anything that really happens there after that is, it's life, right? There's a lot of people that don't stay anywhere for longer than a year, but the intention there is you do have to live there. Yes. So you have to be willing to make that sacrifice.
And the beauty in the 203K is they'll give you money for the rehab and the money for the purchase. So for those that are listening, when Matt's saying 3.5% down, typically with this strategy is you get the seller to pay some closing costs.
Yep.
Your 3.5% goes to the down. The bank then funds you the purchase and the rehab, except for that 3.5%, and you negotiate and get the seller to pay, 3% closing costs or 4% closing costs, maybe to 5%, I guess, is what you're looking to do. So then you can get this property, like Matt said, you've got to qualify for it, but the qualifications are really minimal compared to other programs that are out there, and it gives you the money for the rehab, and you can buy duplex, threeplex, fourplex, which is with what Matt's saying is they'll use 80% of the income from the unit. Even though you don't own it yet, they know when you buy it, you'll start collecting that cash flow. So they're able to credit you that cash flow, 80% of that cash flow they can credit for you to increase your income, which can offset your debt to income ratio. So
exactly.
Anything I missed there, Matt?
No, he said it very eloquently, much better than me.
No.
Yeah, that's exactly how it works. Yep.
So here's the thing I'm wondering on this. Can you only have one of these loans at a given time? Do you have to pay off the property before you get the next one, or how does that work out?
Correct. So one of the questions I get a lot is, can you use this multiple times? Now, no. Right. Well, you can, but you have to keep, so the FHA rules are you're only allowed to have one FHA loan at any given time. So you're able to get FHA conventional mortgages. You're able to get VA loans through the FHA. You're able to get 203K loans through that. So at any given time, you're only allowed to have one of those open. In my case, right, when I did my rehab on the property, I had some pretty nice equity in it at the end. So I refinanced out immediately. So technically speaking, I could go out and do another one of these. I probably wouldn't just because it's definitely worth it for the first one, but not something you would repeat. But what I try to tell people is like, after getting this one under my belt, having a lot of equity, which I now use a home equity line of credit on that equity to buy more houses, flip more houses, once you do that, it opens up plenty of other doors, right? Like, I don't really need to do that again, because now I have relationships with private lenders. I have relationships with hard money lenders, and I'm able to buy property now with a lot of different avenues, not having to use conventional bank financing anymore.
If you got value out of our discussion today, please subscribe, rate, and review the podcast. It's a big help to me.